Hi, welcome to Construction Business Management. This is Module 1B, and today we're going to be looking at business structures. So let's take a look at some of the topics and areas that we're going to look at in this short video. We're going to be looking at the various forms of business ownership. That's going to include sole proprietorship, partnership, and corporation. So that's really going to be the discussion today, those three areas, as I mentioned. And we're going to dive deep in some of the advantages and disadvantages. After all, this course is about you wanting to start a construction related business. And there are different ways that you can start and formulate this business. So we'll go over the advantages and the disadvantages of each one, and they definitely have their advantages and disadvantages. Sole proprietorship, you should think of it that it is you. You're the business. So sole proprietor means what it says. And you're taking all the risk of loss. And so there is unlimited really liability from that perspective, meaning that you are the business. So if the business does things it shouldn't do that causes issues, you're responsible for those issues. Now you can insure your way around a lot of those issues with various insurance, but it's also from a taxation point of view a big issue as well. So usually it's going to be that person that operates and manages the firm. It doesn't mean you can't have employees, but it does mean that you are the person typically that's operating and managing that firm. And it really is, in Canada anyways, the most common form of business ownership. In most jurisdictions, I would suggest that it is the most common form because it's very easy to set up. Very easy to set up. So it's ideally suited for small scale retail and service businesses. So you want to start a renovation business, very easy to set up. You want to start a small consulting business, very easy to set up. And so it kind of depends what type of business in construction do you want to set up and structure yourself as. But we'll talk about some of the advantages and disadvantages of them. If the business loses money, you can write them off against other income. So if you can expense a portion of your home with Revenue Canada, you have to be able to substantiate you're utilizing that. So don't get the bright idea, oh, great, I've got this $1 million mortgage in Toronto or Vancouver and I can expense it all. Well, what percent of that are you using for your business? Is it one room in that house? Is that 15% of the square footage of that house? So again, you got to consult with your accountant on that, but basically you can expense things that you are utilizing. You buy a home computer, you buy printers, you buy a vehicle, you buy your cell phone. There's percentages that you would be able to definitely expense towards the business that is representative of what you use in the business. If you use the vehicle 100% in the business, then you should be able to expense that 100%. If you've only got one vehicle and that's also for personal use, maybe 50%. Again, talk to your accountants for those particular items. But proprietorship, you are that person, you are that business. And so that's when you file a tax return, that is the tax return that you are filing. It's your own personal tax return that way. So that's a consideration. Some of the advantages, you get to keep all of the profit. You make 30,000, 100,000, whatever during that particular year. So that's you're the business. Ease of formation. So it's easy to start, easy to stop. Not a big deal. It's your business, so you're the boss. Secrecy of operation. Well, the only person that really has to know about your business is Revenue Canada or the IRS or whatever your revenue source is. Very low cost of starting. You can start it very instantly, very quickly. Disadvantages. Well, you know what? You're pretty well off. You've got this house, and maybe you didn't get the right insurance for your business. Well, people can go after your personal assets. Or maybe the insurance doesn't cover everything. So the people that are owed money for a variety of things could go after your personal assets. So that's a biggie, especially in construction when we consider cash flow, and we consider, we've got a client and all of a sudden they've decided to stop paying us and they owe us $200,000, and then we've got all these creditors that are after us. That can be a pretty trying experience. So those can cause a lot of problems. So they can go after your personal assets, especially when you have assets to go after. That's problematic. You really can't, like if you're a developer, like you're trying to start a development business, like how are you going to raise capital? And you're this small entity. Investors are going to be looking for a corporation, not necessarily an individual. So it kind of limits your ability to raise capital from those perspectives. So if you're trying to be custom infill homes and developing properties and that sort of thing, it's going to be very difficult to do. Raising that kind of capital. Renovation's not a big deal. You could definitely do it that way, but again, you might want to consider the financial aspects of the unlimited financial liability. Lack of permanence. Well, that's the other thing. So it's a family-run business, but something happens to you. Doesn't matter that they're your family. You're the only one that could write the checks. You're the only one, you're the business, and now you're not there. That's caused a lot of problems for businesses that were reasonably successful, and now something unexpected happened to the owner, and then the family members want to pick up where you finished. It can take a bit of legal ramblings, and you got to create a corporation or a business. It's not an easy transference that way. So it is easy enough if you're still around and you want to transfer from a sole proprietorship into a corporation. Those steps and processes can be done. But if you're in the middle of projects and something's happened to you and the family or members want to continue this business, can put it in a pretty strained way. Not that easy to pick up the pieces. And that delay can be enough that it can cause a lot of major issues. So lack of permanence. Management deficiencies. Well, it's only you, so maybe you don't have partners. That's one of the issues in construction too. It takes a lot of different kinds of expertise to run a successful construction business. Maybe you have the design expertise, or you have the the BIM expertise, or you have the technical on-site experience expertise, and you partner with somebody that has all the financial, business, selling, negotiating kind of expertise. That can be a good collaborative arrangement. But a sole proprietorship, it's you. And possible tax disadvantage. Well, from a taxation point of view, you're a sole proprietor. You're the business. You file an individual tax return. So you can't spread out your income over a number of years. You're taxed at a different rate. You're taxed fully at the individual rate. In most countries, there's a corporate rate, which tends to be a lot lower. So in Canada, our corporate rate is a lot lower than it is on the individual rate. So as an example, and this is very simplified, you have to consult with an accountant, but a corporate business might be around 25% corporate tax. An individual tax, if you're making a lot of income, you might be at 50%. And so that's a 25% gap. Now, it's not that you're getting that full, but no, don't think that the tax person is letting that go. But you get taxed at the corporate rate at 25%. So that's 25% you're not paying in tax that you can leave in the corporation to reinvest in the business. It's almost like the benefits of an RSP, right? Where you don't have to get taxed right now on that 25%. You can reinvest that in buying properties and other things. And then it grows within the business. You're reinvesting in the business. You see, the government wants you to reinvest in the business because they want you to be successful. If you're successful, you're going to hire people. If you're hiring people, you're going to collect things like employment insurance from them, the Canada Pension Plan from them. You're going to be contributing to WSIB and other aspects. So they want you to be successful. So they're happy if you reinvest in the business. But under sole proprietorship, you don't have those opportunities. You are paying that 50% in that year. And so you can't do some tax planning efficiencies because every business, you don't necessarily have 10 straight great years. You might have 5 great years, and then you might have losses during some of the years. So if you have some of that money built in, you can do more effective tax planning with a business from that perspective. Partnership. Well, as I kind of mentioned already, partnership is you combine the talents and resources in a business for the purposes of earning a profit. It's hard sometimes for one person to be fully resilient through starting a business and running that business. Partnership, a lot of times it's like a marriage, right? If you've got a really good marriage, things go really, really well for you. You leverage on each other's talents. For example, my wife's a great negotiator. She's really talented at certain things, and I rely on those talents, and she relies on certain talents that I have. So you definitely want to have, in a partnership, you want to have somebody that probably complements your talents pretty well, that you've got this expertise, they've got that expertise, and that's helping to grow the business because both are really required to be successful. So you can have basically two types of partnership. Well, there's more than two types of partnership. And there's limited liability partnership. There's a bunch of things that go on. But as far as construction-based businesses go, it's really a partnership, and then you get taxed like you're both sole proprietors, to be honest. So it's basically you each file individual taxes based on the partnership agreement. And your partnership by express agreement or by implication. You can think of it this way, that by express agreement, you really sort of defined the partnership, who the partners are, you've had it drawn up legally, you know what each partner has brought into the business, so that also if there's a dissolution of the partnership, you have it sort of defined how that would be dissolved. Many partnerships have trouble when they want to dissolve because there's no real clarity on how it could dissolve, because like marriages, some marriages don't work out, some partnerships don't work out, or maybe one partner's older than the other partner and they want to retire or that sort of thing. So it's good to have that kind of defined in an agreement. That way there's clarity on the aspect. Maybe one partner brought more cash into the agreement, so they have the option of first buying out the other partner if that's the case, and it's based on a certain process. That's a pretty good way of doing it. So you can almost think of it like, if we're using marriage as the analogy, you can almost define it like it's a prenup. All right, you're entering into this partnership, and this is the agreement of how it will work. And if it shouldn't work, this is how we can dissolve it without necessarily dissolving the overall business. Partnership by implication, well, it's kind of like you went to Las Vegas, you got married, and let's see how it works out. That's what else can I say? So that's partnership by implication, right? It might not be favorable the way that you thought. So that's why it's highly recommended to have an agreement if you're entering in a partnership. So as I mentioned, it's like a marriage without a prenup. It's easier to do though. Sometimes in a marriage, that's kind of tricky to do, right? At different times, but definitely, you've got somebody that's multi-millionaire and they're getting married. You want to give some thought to those kind of things. So same thing with business. Partnership. All right. Kinds of partnerships. Limited partnership. That could be where you have a limited partnership where one of the partners has provided money, but they're not involved in the day-to-day business processes. So that means that you're limiting your liability to what you invested in the business. Seek legal advice on this. There's been cases where this person's given to a cousin, $100,000, and I'll be a limited partner in this business. But then they start getting involved in the business, and then it's proven that they're not a limited partner. And then meanwhile, they're the ones with the asset. The cousin really didn't own anything. So the creditors are all coming after the limited partner who they're saying is not limited because look, they signed delivery slips of construction materials that arrived on site. They're not a limited partner. So you definitely want to seek legal advice if you're going to take action in that sort of way. And in all processes, you definitely want to have a good accountant. You want to have a good lawyer as part of your advisory for running your business. Look, These people have spent their lives in those particular areas. You may be good at construction, but they're good at those things. Don't try to do your own tax return for running a business. That's ridiculous. Okay, fine, there's software and you could manage it and you could save a few dollars, but you could miss something that would have huge tax implications that could save you tens of thousands of dollars because you don't know. So I would definitely strongly recommend you build a team of people that you trust. And of course, it's going to cost some money, but you definitely want to get those clarities put into place. Don't skimp on those areas. So partnerships, advantage, easy of establishment, the complementary skills aspect, greater capacity to raise funds. Well, you got more people, you got more knowledge in that company, you got more contacts, you got more relationships. And investors might see it as being stronger too with the combination of partners. So can also be a possible incentive for key employees that you might want to grow into the business, and you can think of it that way. Unlimited financial liability, that's the big disadvantage. It's like a sole proprietorship in that way. Possibility of management disagreement, well, that's a very real possibility. Sometimes people get jealous of each other. I'm working 60 hours, they're working 35 hours a week. I don't see the fairness. I want to break this up, right? Even successful partnerships have had those issues. Limited, it's more limited. It's not as limited as a sole proprietorship, but it's definitely more limited than a corporation. Lack of continuity in the firm, it can cause some issues with that. So if something happens to one of the partners, what happens? That can be concerning. So you're in partnership with somebody and something happens to them, and now that somebody's spouse maybe is inheriting part of that aspect. There can be issues that go on. Who gets the other 50% of the business? What is the agreement with that? As long as you have a well thought out agreement, that can help in those cases though. You've got the same issue with the taxes as you have with the sole proprietorship that I mentioned. You don't have a corporate tax rate when you're a partnership. So that's another biggie with construction, especially when you have different revenues coming in different years. So that gets us to the corporation. A corporation, it's in most developed countries, it's like a separate entity. It has it files a separate tax return. It gets sued separately in the court system. So that's the corporation. You can watch all kinds of documentaries that kind of paint a very negative picture against the corporation. Usually it's talking about publicly traded corporations in those examples, because you have CEOs that are operating under the veil of a corporation, meaning that they've got a lot of personal protections in place. So as far as personal liabilities and things like that, you could own controlling shares of that corporation, but there's a lot of protections that are in place for your own personal properties and other investments, etc. So it really does eliminate a lot of the disadvantages of a sole proprietorship. Seen as a separate legal entity, it can sign contracts, it can sue and be sued. So that's a big deal, and it has to have, of course, there's, we haven't got an artificial intelligence as a corporation, or like Bitcoin seems to have. We have basically individuals that act on its behalf, and it's owned by shareholders who may or may not be employees. So you can have people that are working for you. They could buy, if it's a publicly traded company, they could be part owners of the company because they can buy shares. So there's different types of corporations. It can be basically a private corporation or a public corporation. So those are two big differentiating steps. If you work for a very large construction business, you may be, like an SNC Lavalin or a Bird Construction, you can buy publicly traded shares of that. Or you may have businesses that are employee-owned, where the shares, there's some sort of share scheme within the corporation. Or you may be a private corporation where you've got you're the main driver of the business. You started it, you founded it, and you owe 60%. But then maybe you've got children that you've already given 10% of, 4 kids, 10% each, or a spouse that owns a certain amount of the shares, etc. And that can be all planned out what is the best for a variety of purposes. Again, working with your lawyers and working with your accountants to make sure that you're structuring it to provide the best benefits depending on that type of business. Sometimes businesses, larger entities, will protect themselves by starting a separate corporation, say for this development. So this corporation owns that corporation, and if something goes on in this development, you've limited the liability to this development, not to the broader corporation. So there's all kinds of complexity that can be involved in that, but that definitely offers a lot of protections in place. But you get in the idea that it also costs a lot more to set up and to structure. It costs a lot more to file taxes with, because now you're filing a separate tax return for that corporation, and it tends to be a more complex tax return than, say, a personal return like on a sole proprietorship. So there are those differences that way. But as I said, you can spread out your earnings, so you can just pay the corporate tax at a lower rate. You keep that money within the business, which is helping to develop and feed that development, which means that you probably have to borrow less money from others or finance less parts of your projects. And that's a big advantage that way, that you can reinvest it. But by the way, as I mentioned, the government tax, Revenue Canada or IRS, they're not stupid. When you want to pay out you want to take that money out of the business, you want to pay it out, say, as a dividend, then you as an individual have to pay a dividend tax. And if you take the amount that's the corporate tax plus the dividend tax and you add them together, guess what? Very close to what the sole proprietorship rate is. So it's not like oh wow, who wouldn't start a corporation, 25% gain? No, it's better tax planning, better reinvestment to have that money grow within the business. But as individuals, as you take your money out of that business, you try to take that money out, you have to pay a dividend, like basically the dividend tax rate for that money that you're receiving, because it's a portion of the growth of that business, the profits that are being paid out. The retained earnings of that business that are being now paid out if you're taking it out. But a lot of opportunity for tax planning, and there can be some really good things with a corporation from that perspective. So any construction, what I'm going to get down to with this is any construction business of any kind of size is not going to be operating as a sole proprietorship. Like once you may start out that way, but at some point you are going to move into a corporation. If you're really tight on your capital and your assets, well, then you probably don't have that much to lose either. So again, consult with your accountant and your lawyer on this, but you might start as a sole proprietor. But if you're starting any kind of sizable business in construction, you would want to start as a corporation. And that would be your easy way. You're building things. You've got all of this suppliers and materials coming and going, and clients, large amounts of money. Even small projects can amount to large amounts of money. It'd be much better to be able to say, you know what, this client, they're not paying us. There's this legal cost. We owe, $400,000. Then you can talk to lawyers, etc. You can close down that business and still not necessarily be impacted personally on it. That's giving you some more options that you don't have when you're a sole proprietorship as easily. Well, you could declare personal bankruptcy, but you can only do that if you don't have the assets and the capital in the banks. So that's where, again, you need a lot of thought and consulting that goes in on that. Separating out the difference between what's a sole proprietorship, what's a partnership. And again, if you go into a partnership, make sure that you have an agreement or a corporation from that perspective. And it's not that you have to be a giant business corporation. Corporations can be still, it's not a fortune to start corporations. But it is just more expensive than a sole proprietorship. So my advice really would be any kind of construction business that's sizable, where you're dealing with a lot of buying of materials, a lot of contractors, etc., large amounts of money. You would probably want to think about that. On the other hand, if you've got a small service sector, doing coordination, like a BIM coordinator I'm thinking about, or a something along those lines, well then again, seek legal advice. That might be okay for that kind of effort, as long as you have the proper insurance in place to protect you in case something goes wrong with one of your designs or advice, etc. But other than that, that would be a real possibility in there. So those are some of the differences that way. Now, with private and public, you're only going public if you've reached a really good size. And then a lot of businesses still really think about it. There's a lot of very large family-run construction businesses, very large, multiple billions of dollars, that are still private. They don't want to go public, because once you go public, then you don't have secrecy. You have to publish your financial statements. You have to follow very clear guidelines. You have to give guidance as to how the business is doing, because it has to be transparent. And so your decision-making powers too may be diluted. If you've done it to raise capital, maybe you no longer have 50% of the shares. So it's theoretically possible for you to lose control of your own business that you started. If you don't believe me, Steve Jobs, when he started Apple with Steve Wozniak, but when they grew to a certain extent publicly, and they were a public company and he was running it, when the shareholders weren't happy and the board wasn't happy, they were able to oust him. It wasn't until 10 years later when he came back, and he'd grown a lot and learned a lot with basically Pixar and the Next system. He was a different person, and he came back and he really was able to take the reins. But it can happen even to some. If it can happen to him, it can happen to a lot of people. So private corporations versus public corporations. But in construction, in a development sector, there's real opportunity to raise hundreds of millions of dollars, billions of dollars in some cases, with a public share offering. So that's the other side, and that's where that's really takes a lot of thought. Maybe we are a family-run business and we kind of feel that we've hit a ceiling, but we have developed into this real large entity. But if we want to go to the next step to be one of the largest companies operating in North America, that might be a logical progression at that stage. But for most of us, private corporations, construction, that's where you're going to see the most of it. All right. It's always interesting. You can look up what are the public corporations that are in construction. You can even look at buying shares of them, etc. in the marketplace. Not hard to do from that perspective. But transparency, you have to be transparent, and you have to follow all of the guidelines that if it's going to be traded publicly on the stock market. So advantages: limited financial liability. It's only, you bought shares of this company publicly. If it's a publicly traded company, that's, if it goes bankrupt, well, you just lost your shares, but that's it. If it's a private corporation, again, what you put into it, it's not impossible, but it's very difficult to pierce the corporate veil. That's the way they like to say it. So corporations have that protection in place. Easy, something happens to the owner. Well, who inherited their assets? Oh, it's the spouse. Okay, so there is that easy transference that goes on there. Now, again, you may want to look if you're forming a corporation with two individuals instead of a partnership. Well, what happens if my partner, something happens to them? Their spouse takes it, and you don't want their spouse to be making decisions with you. You might want to have some sort of agreement and legal agreement that you would discuss with your lawyers. But it goes from lifespan to lifespan. Lots of tax advantages, as was mentioned. Extra costs, extra restrictions, especially on publicly traded company. If it's publicly traded too, lack of secrecy of operations. If it's a private corporation, though, you don't have to tell your employees or anything. It's just when it's public. Lack of personal interest by management. Well, if you grow that much, they might not care about the business the same way. So those are the other aspects. You see where you have large businesses and an owner doesn't want to run the business anymore, so they get a CEO to come in. Maybe they won't have the same kind of passion for that business that the original owner does. But that's a different problem. That's a kind of a different problem. You have to really sort of get into that aspect of it when we talk about it. And those are the things that can occur. So you can think about it from laws of business and life. We have a finite amount of time. We have a finite amount of money. Therefore, choose what you're going to do with both carefully, and you'll meet with the greatest success. And so from a business owner perspective, we must determine what's the best business for them to be in. Like, what if we're a business owner, what structure should we go with? What makes the most sense to us and the business at this stage and in the business's life cycle? So where are we at? Consult very well for that, but you now have a good understanding what's a sole proprietorship, what's a partnership, and what's a corporation. And you're not going to be starting a brand new construction business as a publicly traded corporation typically. Usually that's going to be something that happens over time with growth. So I'm Tom Stephenson, wishing you a wonderful day, and we will see you next time. Bye for now.